Welcome back, traders and investors. We have Larry McMillan on the line, founder of McMillan Analysis Corp and OptionsStrategist.com. Larry, how you doing today?
Great, Joel. Great.
Could you just give us a little bit of your background, education in the markets, and a little bit about your site?
All right. I've been trading options since I started trading in 1973. I guess I probably most well known for having written the book Options as a Strategic Investment, which came out in actually in 1980 was the first edition. It's in the fifth edition now. I was a trader, prop trader on Wall Street. I ran an op department for 13 years, and I started this company, Option Strategist, in 1990, I guess it was. So we're coming up on 24 years on that. And basically, we do three major things. We manage money in individual accounts in one particular option strategy. That's one thing we do. Second is our research and newsletter publications, and then third is educational information, including books, CDs, webinars, etc.
What do you think's the biggest mistake people make when they get started in options trading?
Well, easily I would say it's buying out of the money options. They look very, tantalizingly cheap, and they usually expire worthless. So you lose 100% of the money you put up. It takes a certain amount of discipline to start buying options that are in the money and start treating them like a slightly leveraged tool to trade stocks rather than a lottery ticket.
Okay, so you say avoiding the out of the money stuff, either go in the money or a lot of the options traders that we talk to that we have on the show talk about option spreads, kind of defining your risk and also your reward. Is that something that's part of your strategies?
Well, I'm a little bit different on that. Basically, option writing is a good thing and probably the more professional way to approach it. In our managed accounts, we sell puts and we hedge ourselves. But I don't always just hedge myself through the vertical spreads. Vertical spreads are the bull spreads or bear spreads where you use two different strikes with the same month. I see a lot of that on television and everything, but I have to tell you that most of the professionals I know, that's not a staple of their strategy. They use that strategy when options are overpriced, but otherwise, when you buy an option, the risk is limited anyways. So, you can adjust for that if you only want to invest $1,500, let's say, or $5,000, whatever it is, in a particular position. You just buy that number of options, but the spread cuts off your profit potential. And any spread, I don't care what kind of spread it is, cuts off your profit potential unless you're, thinking of it as a selling spread. But these are mostly people buying these spreads for profit. So you buy a bull spread because you expect the stock to move higher. So I generally, in my seminars and things, tell people that, the bull spread is only really usable if the options are overpriced. If the options are cheap, as they generally are now, all over the board, options are cheap. You really don't need to be selling that out of the money option to lower your risk. You just lower your risk by buying fewer of the main option, and then you just hold that one, and you have unlimited profit potential. Because if you cut off your profits, you're eventually going to pay for those. Eventually the stock will move through there or something like that, and you'll be stuck with a much smaller profit than you could have had without that hedge.
So let's talk about this period of low volatility here in the options markets and the overall market. Has that made things a little bit more difficult for you, or are you able to adjust to different volatility environments?
Right. Well, in one of our newsletters, we mostly just do speculative option buying, so it's been good for that because
Right.
options are cheap. um, if volatility is low, usually people look at the VIX, and they see the VIX being low, and then all these people on television are telling you, oh, this is very dangerous. Well, if you go back and look, VIX has been very low a couple of times in the past. The first time was back in 93, 94, and then again in 05, 06, and into '07. So when it gets low, it can stay low for a long time. And those who are saying that it's a danger warning right now because VIX is low, I mean, it might be a warning for some time in the future, but it's not necessarily a warning for right this minute. The way we're looking at, or I like to look at it, is I like to look at the trend of VIX. Right now, VIX is pretty trendless. It's going down to sideways. So down is bullish, sideways is that's kind of bullish too. But if VIX starts to trend upwards, that's when you're going to have a problem. So right now we're putting sort of a line in the sand at 13. If VIX goes above 13, which is above last week's highs or the highs of a couple of weeks ago too, then I'd be more concerned. But otherwise, down in here, I think it's okay. I mean, it's certainly not ideal for the market to go up. But I think the market can continue to go up with VIX being down at these low levels. Now, having said that, this particular week happens to be a seasonally negative week, the week after June expiration. We just put out a little research piece the other day on it. In 18 of the last 24 years, the market has declined during this week, and when it declines, it usually goes down about 1.5%. That's not a huge amount, but it's still, it's still decent. It's like 30 S&P points or something like that. So, you could make money on a SPY put purchase this week, but then that's just this week. That's just a seasonal thing, and you got 4th of July coming in, so you'd probably be pretty dull that week. So overall, I'm looking at this low volatility as, it's sort of a nuisance if you're an option writer because premiums are low, but it's a benefit if you're an option buyer for the same reason. And I'm not viewing it as all that negative unless VIX goes above 13.
Okay, and you mentioned, well, you've been in the business for a long time, so you've seen some different, changes in the options market. These weekly options have just seemed to really come to the forefront. Are they part of your strategies, or is it too short term for you?
No, they're part of our strategy. As I said, in our managed accounts, we're mostly sellers of puts, so we do sell weekly puts. Also, in our newsletters, in the ones that we do option writing, we also sell some weekly options there. I think we just recently sold some CBS weekly options. The CBS options are pretty expensive because there's some lawsuit or something going on in Congress, or something with the government regulations of the broadcasters. But in general, I mean, and if you have, like, say, a seasonal period like this week, you have a weekly seasonal bias to the downside, then you could buy the 1 or 2 week options, because if you're going to get the most leverage out of those if you're right about the seasonal pattern. And as I said before, you know what your risk is. Your risk is what you're paying for the option. So you can adjust that. We usually recommend people don't invest more than about 3% of their trading account in any one trade. So, if you're going to invest, $1,500 or something in the weekly trade, then you buy the correct number of options. So that's your risk, and you're not going to. If the seasonal doesn't work out, well, then you only lose that portion of your trading account.
Okay, you mentioned selling of puts here in your managed account. So is that just a pure position, the selling of puts, or is that part of a hedge? Because as we know, you can sell puts for a long time at low premiums, but boy, and I'm sure you're being familiar with being active. I mean, there's people that just have gotten wiped out. Short puts, short puts, short puts, and then that day of reckoning comes,
Right.
and they lose a lot. So is that selling puts? I mean, your average investor really can't do that safely and without putting up significant margins. So would you
Right.
discuss
You
that?
have to put in more margin, that's for sure. And well, we hedge ourselves. We have two ways to hedge ourselves. One is we're doing a sort of a three-legged strategy in the spider puts or the SPX puts. But the real ultimate hedge is that we buy some out of the money VIX calls as disaster protection. So right now we're buying, let's say, the 19 or 20 strike, and if something really bad happens, I mean, if somebody, sets off a nuclear weapon somewhere in the city or something like that, and market completely collapses, down like 50 S&P points in a day or something like that, VIX is going to explode to the upside. It'll go into the 20s or the 30s. Where you can go back and look at, in the flash crash, it went up into the 40s in August of 2011 when we had that downgrade of U.S. debt, and the S&P fell 80 points in one day. VIX went up to 48. So that kind of disaster would be, as you pointed out, would be very bad for put sellers. But if you own these VIX calls, then you're going to be
Do you,
hedged.
do
So
you,
that's our disaster hedge.
do you always have them on? Do you always have on that black swan protection, or you just do
Mm-hmm.
it? You do.
Yeah.
You always have it on. And how do you do? How do you do it commensurate with the accounts, the dollar value? I mean, how do you figure it for each individual client?
Okay. We do it this way. If I want to hedge $100,000 of notional risk, then I buy 7 VIX calls,
Mm-hmm.
1 month calls, 7 points out of the money, and so that's the way we do it. There's actually quite a bit of historical precedent for that formula, but that's what we're using. And if you're selling puts, then you have more notional risk than just the amount of your account. So you have to take that into account. In other words, if you sold, let's say, 4 spider puts with a strike of 170, then your risk there is 170 times 4 times 100, 68,000. So if your account maybe isn't that big, because you can sell puts with leverage, as you pointed out, due to the margin requirements that the exchanges use or the brokers use. And so you have to figure in the entire risk in case the market collapsed. You would be, in theory, you could get put on all of those.
So what? Just wrap things up here. What a run we've had in the market. Coming off a quad wedge expiration, Fed seems to be accommodative. Janet Yellen's not worried about inflation. The gold market is. I mean, what do you see that could derail this bull market?
I think it would come out of the blue. In '06, '07, what happened was, I don't know if you recall, but China raised interest margin rates. And it seemed like a sort of innocuous thing at the time, but it turned out to be a disaster, and S&P fell 50 points in one day. And after that, things always had a kind of a nervous edge to them, and then, of course, we went into the bear market later that year. So it'll probably come out of the blue. It'll probably be something that we didn't even really think about. Uh, as you point out, this market doesn't seem to be too concerned with global things like Crimea or, revolution in Iran or any of that kind of stuff. It just shrugs it all off. But this it is it's something that with volatility this low, you can buy things that are pretty cheap to protect yourself, whether they're S&P puts or whether they're VIX calls. And I would say it's something you probably should be doing, especially if you have a lot of just straight out risk in your portfolio. One other thing I wanted to mention, we follow put call ratios as a measure of sentiment, and they're still bullish. I mean, I would just say they're in the overbought category, but there's no sell signal yet from that area either. So sentiment is not crazily bullish at this time. So it's just
It's just
kind of
the
like
status quo.
yeah, right, exactly.
Okay, we've had Larry McMillan on, founder of McMillan Analysis Corp and OptionStrategist.com. Larry, major years of experience here in the options market, sharing it with us today on Benzinga's Pre-Market Prep, brought to you by Options House. Larry, thanks for coming on, and hope to see you or talk to you again.
All right, Joel. Thank you.